Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So far, 5 main problems I have completed on valuation of goodwill. Now in this video, 6th, 7th, 8th, 9th, 4 more problems I'm going to explain. So if you want the perfect knowledge, watch all the videos from beginning till end, don't skip in between. I have uploaded so many subjects videos. So you visit the playlist of my channel, select the subject. I have uploaded the videos on financial accounting, cost accounting, management accounting, corporate accounting, income tax, statistics, financial statement analysis. So many videos I have uploaded for graduation level and also for post-graduation level. For post-graduation level, for MBA students or for professional students, professional courses students, I have uploaded the videos for accounting for management, statistics for management, investment management, financial management, operation research, so many videos. So if you want the perfect knowledge, visit the playlist, select your subject, watch the video till the end. Definitely you will gain a lot of confidence on the subjects. Now before starting the 6th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep ready the problems. Take the screenshot of the points, then I'll explain. Now, 6th problem. Problem number 6. The following is the balance sheet of Mr. Chandy as on 30th September 2005. Assets are given, land and building, plant, investment, stock, bank, debtors, capital, general reserve, creditors. Now regarding assets, we should take all assets except investments, because we assume investments as long-term investment, non-trade investment. So while calculating goodwill, we need capital employed. For calculating capital employed, 3 assets we should not consider. That is goodwill if it is given. Then investments, non-trade investments, we should not take. Fictitious assets if it is given, we should not take. So here investment will ignore. Then stock, bank, debtors. Then the following are the net profits for the year ended 30th September 2003, 32,280. Then 2004, 36,870, 2005, 43,350. The last 3 years profits are given. The above amounts include income from investment 1,800 each year. We should not take investments and we should not take income from investments. The income from investments are 1,800 and it is included in the net profit given. So from every net profit we deduct 1,800. You are required to value the goodwill of the above business at 2 years purchase of the average super profit for 3 years. So we have to take the average super profit for 3 years and number of years of purchase are 2 years. Taking into account the fact that standard rate of return on capital employed in such type of business is 10%. This is the NRR, normal rate of return. Assuming that each year's profit is immediately withdrawn in full by Mr. Chandy. So it is given that assumption that Mr. Chandy owner, he is withdrawing the profit every year. When he withdraw the profit each year, the capital employed will remain same. The opening capital, closing capital will remain same, because whatever profit earned during the year he is withdrawing. So there is no need to calculate average capital employed, only capital employed we require. Now come on, start. We will start by calculating capital employed. So calculation of capital employed, land and building, plant, stock, bank, debtors. See, investments we have not taken, right? Because it's a non-trade investment. That is assumption. Now outside liability are only one, that is creditor. Subtract creditors, we'll get capital employed 1,74,000. Now multiply capital employed with normal rate of return NRR given in the problem as 10%. So 1,74,000 into 10%, 17,400 normal profit. That's all. Now we need the future maintainable profit FMP. Past average profit adjusted for future changes. Here average profit. 3 years profits are given 32,280, 36,870, 43,350. But in these profits, income from investments are included. So subtract, deduct interest on investment, income from investment 1800 you subtract. Now trading profit, the operating profit is 30,480, 35,070, 41,550. But you can observe here the trading profits are in increasing trend. So it is better to calculate weighted average, not simple average. If it is fluctuating, we would have calculated simple average. But here it is increasing trend. So we calculate weighted. 2003, 4, 5, 3 years. The profits just now we have calculated. Take those profits. The weights are 1, 2, 3, right? Multiply 30,480 into 1, 35,070 into 2, 41,550 into 3. We get the weighted profits. Take the total of the weighted profits, 2,25,270. And the total of weights is 6. Weighted average profit is equal to summation PW divided by summation W. PW means weighted profit. 2,25,270 divided by 6, you'll get 37,545. This is the weighted average profit. No further changes are there in future. So this is the FMP. Future maintainable profit is the past average profit. Now super profit, FMP minus NP. FMP is 37,545. NP already we have calculated 17,400. Deduct 20,145 is the super profit. Now goodwill is equal to super profit into number of years of purchase which is given in the problem, 2 years. So 20,145 into 2, 40,290 is the goodwill. That's it. This is the end of problem number 6. So every problem you will come across 1 or 2 new points. So focus on those 1 or 2 new points. Remaining points are same every problem, right? And always maintain a running notes. Whatever I'm explaining, note it down immediately in your notebook. Then only you can be able to understand, you can be able to remember. Now, I'm going to start the next problem, that is 7th one. The balance sheet of a partnership firm was as follows. Assets, goodwill, plant, furniture, stock, debtors, prepaid expense, bank balance. Out of these assets, we should not consider goodwill, right? Then capital accounts are given sundry creditors, only one outside liability, sundry creditor. It was proposed to form a company to acquire the business. For the purpose of acquisition, the assets were revalued as under. Actually, assets we have book value and present value. So we should take the present value. Example, plant value, books, balance sheet, plant value 80,000. Whereas present value is 64,000. We should take 64,000, not 80,000. So whenever present value is given, ignore the book value. So here present value, plant 64,000, furniture 4,500, stock 45,000, debtors 28,500, prepaid expenses nil. In the balance sheet, prepaid expenses are given 2,000, but present value nil. Don't consider. Then it was ascertained that the profits before charging remuneration to partners for the past 5 years had been as follows. So 25,000, 30,000, then 28,000, 32,000, 35,000. Last 5 years profits are fluctuating. So we calculate simple average, not weighted average. Included in these profits were non-recurring items averaging 3,000. But from the nature of the business, such income was found to arise every year, and the promoters agreed that a figure of 1,000 should be allowed as profit from this source. So actually profits are given for the last 5 years, and it is given that in that profit there is a non-recurring income of 3,000. Actually non-recurring income should not be considered. We need only recurring income, trading income. So 3,000 rupees are the non-recurring income. But directors felt that this non-recurring income is going to continue in future also. But how much? Only 1,000. So out of 3,000, 1,000 is going to continue in future. So remaining 2,000 not going to continue. So we deducted 2,000 as a non-recurring income. So first we calculate simple average profit. Then from simple average profit, deduct income from non-recurring source, 2,000. Then next page it is given. Similar business had paid a dividend of 8% per annum on their ordinary shares, and the partners who would be directors of the company should be paid a fair remuneration of A 6,000, B 5,000, C 4,000. So other similar business are earning a return of 8%. This is the NRR, normal rate of return. And the fair remuneration of the directors. Earlier, they are the partners. Earlier, it was a partnership business. And in future, it is going to become a company. So in company, we don't have partners, we have directors. So directors' remuneration is payable. So this is the expenses which is to be incurred in future. It should be deducted. Right? Ascertain the value of goodwill at 5 years purchase of super profit. The number of years of purchase, 5. So after getting super profit, multiply with 5. That's it. So it's very simple. Calculating the capital employed. So first of all, plant 64,000, furniture 4,500, stock 45,000, debtors 28,500. These are the present values given in the paragraph that we have taken. And bank balance, directly in the balance sheet it is given 18,000 we have taken. Right? Take the total of the assets 1,60,000. Outside liability only one, that is creditors. Deduct. So 1 lakh rupees capital employed. So we got the capital employed. Now we calculate the normal rate of normal profit. Normal profit is equal to capital employed into NRR, normal rate of return. 8% is given. So 1 lakh into 8%, 8,000 is the normal profit. Now we need the FMP, future maintainable profit. It is the past average profit adjusted for future changes. The profits are fluctuating. So we calculate simple average. Take up the profits, all the profits you add up divided by 5. You will get an average profit 30,000. Add up the 5 years profit divided by 5, 30,000. From this 30,000, deduct the income from non-recurring source. So it is given in the problem 3,000 rupees are non-recurring income included in the profits. But from the nature of the business, this non-recurring income is going to continue in the future. But only 1,000 is recoverable. So how much is not recoverable? 2,000. Deduct 2,000. Non-recurring income 3,000 minus 1,000, 2,000. Deduct 28,000. Apart from that, the remuneration of directors to be paid in future. A 5,000, 6,000, B 5,000, C 4,000. Total 15,000 is the expenses to be incurred in future. Deduct. So 28 minus 15, 13,000 is the FMP, future maintainable profit. Now easily we can calculate super profit. FMP minus NP, 13,000 minus 8,000, 5,000 is the super profit. So goodwill is equal to super profit into number of years of purchase. It is given in the problem 5. So 5,000 into 5, 25,000 is the value of goodwill. That's all. So we have completed 7th. Now we'll start the 8th problem. It's a small problem. See carefully. From the following, calculate the value of goodwill at 3-year purchase of super profit. Again, first we need to calculate super profit, multiply by 3 is equal to goodwill. Now, average capital employed in business 6 lakh. In the previous problem, we have calculated average capital employed. But in this problem, directly in the problem itself, it is given average capital employed. The net trading profits of the firm for the past 3 years. In the last 3 years, the profits are 1,07,600, 90,700, 112,500, fluctuating. So we calculate simple average. Rate of return expected on capital invested 12%, NRR. Then fair remuneration to the partners for their services, 12,000 per annum. This is the expenses to be incurred in future. So what we calculate? First we calculate average profit of the last 3 years. From that average profit, subtract the remuneration of the partners payable in future. That is 12,000. Subtract. We'll get FMP. Sundry assets of the firm, current liabilities. Ignore. We don't require. Actually, current assets, liabilities we require only for calculating capital employed. But here, first line, average capital employed is given. Once capital employed is given, there is no need of assets and liability. Ignore. That's all. So simple. Calculation of value of goodwill. Normal profit is equal to average capital employed into NRR. Average capital employed is given 6 lakh and NRR is given 12%. So 6 lakh into 12%, 72,000 is the normal profit. Finished. Now FMP, take the average profit of the last 3 years. The last 3 years profit are 107,600, 90,700, 112,500 divided by 3. Average profit 103,600. That's the average profit. From average profit, deduct the expenses to be incurred in future. That is the remuneration. Fair remuneration of partners, 12,000 given. Deduct 91,600 FMP. So we got FMP and we got NP. So directly we substitute. Super profit is equal to FMP minus NP. 91,600 minus 72,000, 19,600 is the super profit. Now goodwill is equal to super profit into number of years of purchase. So super profit 19,600. How many years of purchase given in the problem? Goodwill is 3 years purchase of super profit. 3. So goodwill is equal to 58,800. That's all. 8th problem completed. Now I am coming to the 9th problem. The following particulars are available in respect of a business carried on by Mr. Y's head. Average capital employed, just like the previous problem, average capital employed is given. No need to calculate. Then trading results are 2002, there is a profit of 12,200. 2003, there is a profit of 15,000. 2004, there is a loss of 2,000. Actually, loss means negative profit. Then 2005, there is a profit of 21,000. So out of 4 years, 3 years we have profit and 1 year we have loss. The loss we will take negative. Then market rate of interest on investment 8%. And next line, actually there is a misprint there. So in your worksheet, in your question paper, you make some changes there. So after market rate of interest on investment 8%, you insert one more sentence, rate of risk return. Rate of risk return on capital invested in the business. Again I repeat, rate of risk return on capital invested in the business is equal to 2%. That is not printed there. 2%. So market rate of interest on investment 8% and rate of risk return on business on capital employed in the business is 2%. The total normal rate of return is market rate of interest plus rate of risk return. Then last sentence is remuneration from alternative employment of the proprietor. That you cut off rate of risk return on capital. Rate of risk return on capital you cut off. And instead that write on remuneration from alternative employment of the proprietor. Remuneration from alternative employment of the proprietor if not engaged in business 3,600 per annum. So last some printing mistakes are there. So just now I told you how to make the correction. 2 lines. 1. Rate of risk return on capital invested in the business 2%. That is not printed there. Write it down. Secondly, last sentence, cut off that rate of risk return on capital. Instead of that, write down remuneration from alternative employment of the proprietor if not engaged in business 3,600 per annum. You are required to compute the value of goodwill on the basis of 3 years purchase of the super profit of the business calculated on the average profit of the last 4 years. Exactly similar to the previous problem. So first of all, normal rate of return. Remember here, normal rate of return means market rate of interest plus rate of risk return on capital invested in the business. So in our problem, market rate of interest is 8%, whereas the risk return on the capital invested in the business is 2%. So NRR will be 10%. Normal rate of return is 10%. Now normal profit is equal to average capital employed into NRR. Average capital employed is given in the problem 50,000, directly given. 50,000 into 10%, 5,000 normal profit. Now we calculate FMP. For FMP we need the average profit of the last 4 years. The last 4 years. 3 years we are given profit, 1 year we are given loss. The loss means negative. So add up 12,200 first year profit, second year profit 15,000, add up. Third year there is a loss of 2,000, so minus 2,000. Fourth year there is a profit of 21,000, add up 21,000. Divided by 4 years, you will get average profit 11,550. This is the average profit. From average profit, subtract the expenses to be incurred in future. That is fair remuneration of partners. Proprietor. Fair remuneration of the proprietor, 3,600 given. Subtract. We'll get 7,950 as the FMP. Future maintainable profit. Now we need super profit. So super profit is FMP minus NP. FMP 7,950, NP is 5,000. So subtract, you'll get 2,950 as super profit. Now lastly, goodwill. Super profit into number of years of purchase. It is given in the problem 3 years of purchase. So super profit 2,950 into 3, you'll get 8,850 as the goodwill. That's it. This is the end of problem number 9. So far I have completed 7 short problems and 9 main problems. So if you are continuously watching all the videos, all the problems, definitely you got a good command on this topic of valuation of goodwill. So if you are satisfied, give a like to the video, share my channel, give your comment, subscribe if you have not yet subscribed. And by the super thanks which is given below my video, inshallah we'll continue the next problem in the next video.